And this time it's the concept of margins. So Andrew, let's keep on moving. And one hedge fund lost more than $800 million in just one day, in just one shot. It's amazing. It's amazing. How come this hedge fund, usually hedge funds are managing their money in a very strict money management system or under a strict money management system and so on and so forth. How can such thing happen? It is amazing. And of course, major global banks lost hundreds of millions of dollars, and the market was just looked like a mess after this announcement.
It did indeed, and I think that in this particular case, the hedge funds case, this was a huge disaster which happened very quickly. And it was, if you think about other asset classes such as commodities or metals, which you have a physical product, they're less liquid, and therefore these particular traditional companies are founded on, their risk management systems are founded on the basis of less electronically processed assets. Like for example, in Forex, it is such a liquid, non-tangible asset that the whole situation and the whole fortune of any company, as well as any trader, can change in a second. So in the case of this particular company, which lost 800 million, what was really surprising was how many professionals in the industry were shocked and astonished by this. It shouldn't really be a surprise, because in those circumstances, there are some specialist risk management companies. This has been a big wake-up call. This whole event has been a big wake-up call for everybody in the industry, whether a technology provider, a liquidity company, or a Forex company, or even a platform provider who capitalizes his platform on volume. The whole model has changed now. So if, for example, this company had specific real-time risk management tools in place, which are available from specialists, there are lots of specialist risk management providers around the world, it may have not lost all of it, but it might have mitigated the losses slightly.
That's why I got my wake-up call a few years ago, and it happened to me as well. Of course, I lost a fortune, and right now, and this is why we are here. This is why we have the SuperTraderTV, in order to educate traders, in order to let them understand what are the consequences of each and every step, or each and every move you make in the market, and how dangerous the market are, and how to avoid such occurrences in the upcoming future.
Right, I agree, and I think one of those important things is that always history is never. It's very common to look at your own computer screen in solitary confinement and think, oh, where am I going wrong with that? And there's a technology chain here of the platform, the liquidity bridge which connects the platform to the liquidity provider. Then there's all the organization of the liquidity provider, which is doing its own risk management. Then you have the banks themselves. So the trader is locked into watching his screen, but isn't looking at the chain of technology behind it. So all of that is not just real-time matter. There's all of the understanding of how that works, plus what happened before. History, even recent history, because it's such a fast-moving business, recent history can give you some insight into what may happen. For example, this system, this particular circumstance, I don't know if you remember last year, about October last year I think it was, the oldest FX hedge fund in the world went bankrupt. It was John Taylor's FX Concept, and it went bankrupt. It was 35 years in existence, and its mandates were not even retail. They were public sector, US pension schemes and public departments. What happened was, there was no market interference. There was nothing like what we've seen in January this year. What happened was that some of the very senior traders that had been there a very long time started to leave the company for better offers. Newer traders came in with different strategies. The public sector schemes were not happy with these things, and they started to pull out, and the company went bankrupt because of it. Now, all of these factors can happen. If you're a trader and you're looking at your system and you're thinking, this happened, and then it happened because of this January the 15th event, which exposed lots of, as we spoke before, lots of clients' negative balances, lots of brokers' negative balances. If those who are not exposed are in another broker, usually you might think, oh, I'm okay, my broker didn't get exposed to that. But there's so much nervousness that there might be a run on withdrawals. And if there's a run on withdrawals, the broker is likely to change its business model to try and compensate for the for the less volume, which will affect the terms and the way that the market is traded on. So if, for example, a company wants to make margin loans, what it can do two things. It can allow a trader to carry on trading should this particular thing happen, which, although technically insolvent because it's in a negative equity situation, because it's covered by a legal margin loan, there's no insolvency, right? So then it can charge interest for having a loan.
Yes, I know, but first of all, as a trader, I would like to pay more spread rather than pay that to my broker first.
I would as well.
Yeah, so it's I don't know how to express my feeling about this, but I can tell you that it can generate another dangerous theme in the market, because if you are a trader and you are trading out of debt, and you have to cover the debt, you are going to involve your psychology in your trading activity, and that's why you are going to lose more and more money.
But isn't that that's what the banks did, isn't it?
Yeah.
In Europe, they did this. All the banks now in Europe have been bankrupt over and over, and they keep getting bailed out over and over. And there's been all these home repossessions all over the US, and that's because banks found out that they couldn't make enough profit out of traditional banking and commissions, so they started trapping retail customers into debt, which not only keeps them as a customer because they have no choice other than to stay with that company, but it charges them much more than they would be charged if they were in credit and just had to pay commissions on their transactions. And I think some brokers might go down this route.
Okay, so this is exactly what I would like to discuss about in our next segment. It is very important how psychology is involved in our trading activity, and it derives exactly from this particular.
Well, it's a dangerous practice, isn't it?
Very dangerous
practice.
Hello, super traders. Thank you for coming back to our show. And now we are going to discuss about what would be the next preferred brokerage model. So we know that we recently, most of the main brokers went through a non-dealing desk process. That means that the orders of the traders were channeled directly to the market in a STP process, straight through process. And this model is presenting huge losses to the brokerage firms right now. So what do you think about it?
I think that there's many companies, especially the ones that can concentrate on retail clients, have said in all of their marketing documentation on their website, we are a non-dealing desk brokerage that transfers all of our order flow out. But the question is, it depends where they're transferring it to. If they are transferring it to their prime brokerage or to their liquidity provider, then yes, it makes themselves a non-dealing desk brokerage. But the prime brokerage might be operating a risk management model. But I think that true no dealing desk models, where there is no prime brokerage that's got any control over the order flow, no end liquidity provider that aggregates liquidity and then has a dealing desk within the aggregator, I think the days of that now in the retail world are pretty much numbered, because it came in 3 or 4 years ago as being a very popular way of emulating the institutional model. And many technology companies started getting a deal with all the banks, major tier 1 banks, channeling aggregating the liquidity and then supplying it through an API feed to a brokerage. This became so popular because you have then retail clients who can have a variable spread, they can see what the market rate is and actually execute orders exactly as if they were doing so at a bank desk or near enough. But because of these events with the exposures to client losses, this day we can quite clearly see that this model is now going to be probably reversed back to how it was before, at least in some part, because we saw that those operating that model are the ones who really were exposed to in some cases, unserviceable client debt, which actually finished their company.
I can tell you, as from the trader perspective, I really don't care who is in the other side of my trade. And you know why? Because as long as I'm maintaining a low risk exposure and I'm trading with reasonable expectations, and I'm trading under a very a very good money management system, and as long as I'm not losing my life savings in just one trade, I'm fine with it. I'm okay. As long as I'm maintaining low margin levels, it doesn't matter who am I trading against. As long as the broker provides me with a real market quotation, and the execution process should be very fine and very fast, I really don't care.
That's the key, because I don't think there's any harm in warehousing or internalization.
It doesn't matter.
If you're not you see, it used to make me wonder how really convinced retail traders were when they used to see a fixed spread on their account. You think, how can anybody think that is actually a market if it's fixed? Who's fixing the spread?
Exactly.
It doesn't make sense. So therefore, if as you say, if you've got a real price quotation and your EAs and your automated system works with it correctly according to the market,
absolutely,
and the actual brokerage is operating it in line with the market, even if they are actually internalizing the trades, if they are operating it in line with this I think is possibly a sustainable model for the future, because what they're doing is operating a B book but in line with the real market. Therefore, should an event like this happen, they won't be exposed to any negative.
Do you think that it's a good idea for the brokers to go for a hybrid solution?
Yes, I do indeed, and I think that they're actually starting now, almost a month, in fact exactly a month since this event that really has changed the whole landscape of the retail market. The interbank sector will be okay, because they'll be able to write down whatever they had. I'll forget. They're going between each other. They're trading between each other. They're processing order flow. It's 5 or 6 major banks handle something like 50% of all the international interbank order flow, and they're doing it through algorithmic systems, and it's all covered. But the retail brokerages, and not only the retail brokerages, but the prime brokerages that provide them with aggregated liquidity, and the technology companies that capitalize themselves on, they're saying, okay, you can take our technology, it won't cost you anything, and they'll set up the whole thing, and then it's capitalized on monthly revenues. So of course that is important. If there's not enough monthly revenues, then it's very hard to gain business. So if they go to a hybrid model, there's a little bit more margin can be, you as a brokerage can do a better deal with a technology provider and attract them to give you a better system, because you can afford to pay them a little bit more. So it goes like that. Then you can give the client a, even if the client has to pay a tiny little bit more spread, they're not exposed to any risks. Otherwise, the whole industry will go, in my opinion, will go down this dangerous margin lending route, which will just be the worst thing ever that could possibly happen.
Yeah. So, but I think that we can conclude this segment by saying that hybrid is the best solution, as long as it is very we have fair quotation by the brokers, and that's it. Now, the most important thing in margin right now, and what will happen next in the market, this is the most important theme that I would like to discuss about. The current margin levels in the market are extremely high.
They certainly are.
It's, traders are buying stocks, commodities, forex, everything, and of course with extremely high level of margin, and it is ridiculously risky situation.
Yes.
And of course, deleveraging is not a thing that the market is willing to do, and this is the main point that I would like to emphasize.
Yeah.
What will happen if tomorrow traders will have to unwind their positions?
Well, there's a problem, because the only way now under this, we talked about the A-book, the only way under this, what I call the forced A-book model, because now all of the companies are falling over each other, trying to compete with each other for the lowest possible spread and the quickest execution and total A-book model. The only way they can possibly make any profit is by volume. And the only way to generate volume when there's hardly any spread and no client wants to pay any commission, really. It's zero commission by the time they've factored in the introducing broker and the partner that brought them the business. There's so little per trade, and then you have to bear in mind how much it costs to get clients in the first place. The only way that any brokerage can make any profit is by leveraging to a point where a lot of numerous lots are completed in one trade. Now, that's the problem. So if all that have to unwind their positions, we will see what happened to FX Concept last year. Now that was institutional big mandates, and what was happening was they were actually winding back positions as the last institutional mandate stayed in place. And I was talking to their dealing room manager at the time, and he said, that's it. They're winding back the positions. That's it. The company is going after 35 years. So if that happens, that's pretty much the end of all of the A-book brokers if they have to wind their positions back.
Yes, and what will happen to the market? You know, back in 1929, we saw the recession, and we saw free fall and and total collapse of the financial markets, and traders and industry players blamed the high level of margins.
Yes, they did.
So
I think it'll be a different factor that will cause it this time, because that was 80 years ago, almost 75 years ago. What will happen now, 85 years ago in fact, what will happen is that because it's all electronic now, if you have a situation like the European Union collapsing and the euro is a major currency, then that will cause the entire global forex industry to have a similar event to what happened on January the 15th, but much, much, much more loss.
Okay, but it's the same. It's the same picture, you know, just like the subprime crisis in 2008, and we can see that banks responded with unprecedented fiscal stimulus, the monetary policy expansion, and the institutional bailout in the US. Everything is the same. Now, take a look at the US Senate report. It concluded that the crisis was a result of high risk, complex financial products, undisclosed conflict of interest, and this is the same themes. These are the same factors. These are the same facts that currently presented in the market, and that's why it can serve as we can foresee that the next collapse.
That's my point about that. Was exactly my point about how retail customers and the companies that are providing them with a business will refuse to face up to these things that have happened several times before. That, unfortunately, is one of those traits of human nature in a lot of cases. That I remember going back 6 or 7 years ago, banks were lending people who hardly worked and hardly had any income 100 and something% mortgage to buy, no down payment and no capital repayment.
And no due diligence process.
No due diligence
at all. It's crazy.
Nothing. Totally insane. Now, wouldn't that be the same principle as if they started going down the margin lending route? That's effectively a subprime, so-called subprime way of doing business, because what you're doing is locking someone in. And these banks, what they then one way of doing business is that, because they would get a lot of interest for it. But the retail customer will actually tell you to your face, you can't go wrong with property. Oh, yes, you can.
Of course you can. 2008.
Especially if you borrow money. You can only not go wrong with this if you come with the cash and say, there's the cash, that's now my house. If you do the same with Forex or with any liquid asset, and obviously a house is an illiquid asset, and it's even more stable than that, it still went down.
You can buy a piece of land in the moon.
Yes.
It was a pleasure to have you here with us.
Likewise, thank you.
Thank you very much.
Thank you very much. Good to see you.
Thank you very much, Super Traders, for being with us today. Have a lovely and profitable trading day.